Good day, everyone. You are welcome to this week's Business and Investment Tips program, a production of Christ Church Radio. My name is Ayodeji Ebo, an investment professional. This week, the focus is on Nigeria's Q2 2021 GDP numbers. The National Bureau of Statistics last week published Nigeria's second quarter 2021 gross domestic product numbers. The Nigerian economy continued on its recovery path as real GDP came in impressive at 5.01% year-on-year, higher than the growth rate of 0.5% in Q1 2021 and 6.1% contraction in Q2 2021. The GDP growth rate compares the year-on-year change in the country's economic output to measure how fast an economy is growing. GDP measures the value of all goods and services produced in an economy in a given period, usually a quarter or a year. This report used the output approach. Real GDP reflects the actual value of goods and services produced without the influence of higher prices. Simply put, the GDP of a sector can be affected by both the volume of goods and services produced and their respective prices. However, what's important is the increase in goods and services produced rather than price increases. By broad sectors, the non-oil sector, which accounts for 92.6% of GDP in Q2 2021, made a giant leap with 6.7% year-on-year growth compared to 0.6% year-on-year in Q1 2021 and minus 6.1% in Q2 2020. This impressive growth reflects the positive impact of the full reopening of the Nigerian economy, as business activities were halted in Q2 2020 due to the restrictions. On the other hand, the oil sector remained in depression, contracting by 12.7% compared to a decline of 2.2% in Q1 2021 and 6.6% in Q2 2020. This was as a result of 11% year-on-year and 6.4% quarter-on-quarter declines in average daily oil production to 1.6 million barrels per day relative to 1.8 million barrels per day in Q2 2020 and 1.7 million barrels per day in Q1 2021 respectively. Based on the contribution of sectors to GDP, both services and agri sector gained ground while industry contracted. The growth rate in the agriculture sector moderated to 1.3% in Q2 2021 from 2.3% in the previous quarter. Similarly, the industry sector experienced a decline of 1.2% in Q2 2021 from 0.9% last quarter due to 47% and 13% declines in crude, petroleum and natural gas and oil refining respectively. Our takeaways: the low base effect, that is, low GDP numbers in 2020 due to the lockdown, boosted the impressive growth in Q2 2021. 2. The oil sector remained in depression, 6 quarters of contraction, due to the OPEC plus oil production cuts last year as a result of the COVID-19 pandemic. The third wave of COVID-19 may delay an increase in OPEC plus oil production quota. 3. Real growth rate in crop production slowed, reflecting the lean planting season and insecurity. Despite sustained CBN intervention, we expect an improvement in subsequent quarters as we approach the harvest season. 4. Growth in the telecommunications and information sector slowed down for the 6 consecutive quarters to 5.9%, traceable to the complexity in the acquisition of new SIM cards as well as the linkage of NIM to phone numbers. 5. The trade sector came out of depression after 5 quarters of negative year-on-year growth due to the opening up of land borders and improved FX liquidity. 6. The education sector turned positive after 5 quarters of negative growth to 0.6% due to the full resumption of school activities. We expect third quarter growth rate to slow down compared to the second quarter due to minor impact of low base effects. However, the non-oil sector is expected to sustain its positive momentum as government intensify efforts in the vaccination program to reduce the impact of the third wave of COVID. Thank you for listening. Please join us same time next week for another interesting and insightful session. For comments and feedback, kindly forward to ccradio@rccgchristchurch.org or send SMS to 07082463747.